Our first speaker is Mr. Subhash, a well-known figure in the TIA circle, a alumnus of IIM Bangalore. His core competency includes portfolio management and equity research. Founder of TRAM Financial Services Private Limited, Chennai, a firm offering gamut of financial services including portfolio management and MS distribution. He'll be taking a session on P&L and ratios. Over to you, Mr. Subhash. Small request, please keep your mobile in discrete mode. Also, we'll keep the questions at the end of the session. There'll be ample time for that. So, park your questions for the end of the session. Not able to hear?
Yeah. No problem. There's nothing secret in it. Sincere, a very good morning to one and all. Sincere thanks to TA for giving me yet another opportunity to talk to all of you. Saturday morning sessions are quite tough, actually, seriously. Saturday afternoon sessions are actually better. Morning sessions are quite tough. Right, LRB will be in holiday mode, right? And holiday mode, then I'll have to bring you back to the normal mode. It's very, very tough to handle such sessions. That do the first sessions on a Saturday morning. Doesn't matter. I'll try to make it as interesting as possible. We can also make it interactive, right? If you have any questions, you can stop then and there and ask. Okay, this is like a class. Okay, how many of you are from commerce background? How many of you took common group? Okay, and how many of you have done an MBA? Quite substantial. I think then most of what I'm going to teach, okay, it will be just a revision of what you would have already learned in your 11th and 12th standard and what you would have learned in your MBA. That's all. For others, I think it will be something new, right? But since most of you are in markets, right, you must have done or you would have done fundamental analysis at some point, right? So that being the case, maybe if the presentation is good enough that I do not know, only at the end of the presentation, it's for you to judge. There will be some key takeaways. Okay. Today in fundamental analysis, I'll be focusing predominantly on the P&L account, right? See, every company has a profit and loss account. Every company has a balance sheet, right? And every company, okay, you'll have to analyze it using some valuation, some ratios and other things, right? And every company is also valued at some multiple. Like today, okay, make it interactive. What would be a likely multiple of what would be a likely price to earning multiple of a steel company? Can any one of you say? Steel company, iron and steel company. Likely price to earning multiple. Okay, 10 to 15, okay? Somebody says 10 to 15. And what would be the likely P multiple of a well-run FMCG company? Oh, okay. And what should be, I mean, at least in Indian markets, okay, what is the average multiple of an IT company, large cap IT company? Okay. Actually, all three companies are making same profits. right? There's one FMCG company which makes 10,000 crore profit every year. There's one IT company which also makes 10,000 crore profit every year. And there is an iron and steel company which also makes 10,000 crore profit a year. But one company is valued at 15 times, the other company is valued at 20 times, and other company is valued at 50 times. Why? That's what we are going to look into this presentation. That's all. Okay. So the first and foremost in fundamental analysis, right, is reading the profit and loss statement of a company. Okay. What does the profit and loss account reflect, or what does it show up? Okay, if you read into the profit and loss account, okay, you'll be in a position to figure out the revenue or the sales of the company for that year. Okay, and cost of goods sold. Okay, and you will also get an idea of the selling general, say SGA expenses, what we call it as selling general and administrative expenses. And you will also have some idea about the marketing and advertising spend the company does. And you will also get an idea about interest expense. You will also get an idea about the taxes that the company pays. And finally, the profitability of the company. Then it is called a net income or whatever it is, net profits. Right? You will be able to figure out all this information, right, when you go through the profit and loss account of a company. Okay? I'll show you a sample profit and loss account. Okay, please, next 4 slides are very simple slides. Okay, very simple slides, but they are very important slides. Okay, please pay utmost attention to the next 4 slides beginning from this slide. Okay, these are all illustrative examples, very basic examples. I'm going back to 11th standard or 12th standard. Okay. Let's forget that we are all investors. Let's forget that we have all made money in the market. I'm taking you back to your 11th standard. Right, there's a company by name ABC Textiles Private Limited. It's a fictitious company, okay, taken as an illustrative case here. Okay, this is the company's P&L. Okay, the profit and loss account for financial year 22 to 23. Okay. In P&L, the very first word that you will have to figure out, right, which we will have to observe, is for the period. That's very important. Okay, statement of profit and loss account for the year or for the period between April to May, something it would be written, or April to March it would be written. That's very important. So please understand, if you look at a balance sheet, always balance sheet would be as on some date. But profit and loss is for a period. Okay, you need to understand that difference. That's very important. Okay, so this is for financial year 22-23. In that year, what this company has done. Okay, let's look at the revenues. Okay, you just that's P&L. Okay, that's all. Okay, I do not know how many of you write, but the company does it. The company earned about 1,000 rupees, whatever it is. It could be dollars, it could be this thing. There's an illustrative number. The company earned about 1,000 rupees in financial year 22-23 to sale of goods. It is into sale of textiles. Okay, it is a small shop. Okay, assume this company is a small textile shop. Okay, run by a merchant, and the merchant is sold stocks worth 1,000 rupees in financial year 22-23. Right? And there's also some other income. Okay, the company also, or the merchant also earns some other income of 30 rupees. It could be anything. Maybe the company had a fixed deposit. Okay, they put it in a bank, and the bank paid some interest. Okay, and that could be 30 rupees other income, or it could be any other income. Okay, so total income that a company earned is 1,000 plus 30, 1,030. 1,000 rupees came from sale of goods, and 30 rupees came from other income sources. So the total income that a company earned, which I am showing as TI, is S plus O. Okay, if you have any doubts here, please feel free to ask. Next, we'll move on to expenses. The company the first expense. Okay, This is a trading company. This is just a pure merchant, like your provision shop or your textile shop. Okay. The first expense for such a company is cost of goods sold. Okay. What do you mean by cost of goods sold? No, to keep it very simple. We're not going to raw material and all. Okay. Then, okay, the company has sold goods about 1,000 rupees. Okay, let me make one assumption. The company at the end of this year had no stocks. Okay, all stocks finished out. Right? It bought some stocks, right? And at the end of the year on 31st March, it sold everything, nothing was remaining. Okay. Let's understand this based on that assumption. Okay, it was able to manage it was able to clear all this thing, and there was no pending thing. So the 1,000 rupees worth goods the company sold, right? The company would have bought that good at some price. Okay, that is cost of goods sold, right? That is 400. Okay, right? It bought some goods for 400 rupees, right? Cost of goods. Okay, that goods alone it bought for 400 rupees and then sold it for 1,000 rupees. Okay, so that's cost of goods sold. Then you have your selling, general and administrative expenses, right? To run a shop, okay, you need to pay a rental income, you need to pay the power cost, okay, and there will be some people who the promoter would have employed. You have to pay salary to them. All those it gets classified in SGA expenses, okay, which includes your salary, power, all other and expenses. Even now these days, internet cost or whatever it is, merchant discount or whatever it is, GPay cost or whatever it is, it could be all put together as the expenses. And apart from that, there's also some miscellaneous expenses. In most companies, we will not know what miscellaneous expenses are. But in a country like India, okay, miscellaneous expenses are a bit dangerous in nature. It could be of two types. Okay. One, in a country like India, even if you are running a small medical shop or a provision shop, so many people come and take bribe from you. So many people will come and extort, right from third gender to police person. Right? Everybody will come and exploit you, right? You need to set aside some expenses and that gets classified as miscellaneous expenses. In some cases, the promoter also diverts some funds, right, and then classifies it as miscellaneous expenses. So both happens in India. This happens as well as that happens, right? So that gets classified as miscellaneous expenses, 700 rupees, right? Then interest expenses. Okay, this is a small trading company. Okay, it would have taken a loan from a bank. It would have taken an overdraft facility or whatever it is, or even a term loan from the bank, or whatever, a mudra loan, okay, some loan it would have taken, right, and they would be paying some interest on it. So that is classified as interest expenses. Okay, then there is one more expense which comes in the P&L account, which is called depreciation. Okay, what do you mean by depreciation? Okay, wear and tear. Okay, so what happens because of wear and tear? Value of? Okay. This is a small shop, right? So they would have bought a lot of racks, right? They would have bought a laptop for billing machine, everything. Okay, those are all undergo depreciation. The value of those don't remain same every year. So there's an accounting policy which the merchant's auditor would be adopting, and he would be depreciating it and booking that in their P&L. Okay, please understand the depreciation expense is a non-cash expense. Okay, when you buy something, you would have already bought it. Assume he buys a billing machine. The merchant buys a billing machine. The merchant would have bought a billing machine long back. Okay, say 2-3 years back. So at that time itself, he would have spent and he would have paid for it, right? But now you are only depreciating it, correct? So that's actually technically a non-cash expense. A cash outflow happened some time back. Okay, when Yogesh comes and takes balance sheet, I think he'll be focusing on those aspects. So I'm not going deep into it. But for the time being, you understand depreciation is a non-cash expense, right? So after all this is a profit before tax. Okay. Cost of goods sold is 400. Selling and administrative expenses is 300. Miscellaneous expenses is 100. Interest expenses is 100. Depreciation is 40. Finally, the total expense, sum of all this, C plus S plus M plus I plus D, that's 940. 1030 is your income. When you subtract both, okay, you get profit before tax. Right? This is a private limited company, okay? So it pays about 25% tax, assumed, okay, roughly. Okay, tax at 25%. Okay, that's for the government. So 22.5%, sorry, 25% is a tax, and 22.5 rupees is a tax for 90 rupees. So this is profit after tax. It is a very simple P&L. I am listing down the revenues, I am listing down the expense, then I am listing the tax, then I get profit after tax. Correct? Next, there are two more concepts which you will have to learn. Okay? While analyzing companies, those concepts are called, this is PAT, P-A-T, okay? Profit after tax. There is something called earnings before interest and tax. That is nothing but profit before interest and tax. You can either use the word E or you can use the word profit. In some places in the presentation, I would have used PBIT. In some places, I would have used EBIT. Okay, but both are one and the same. So, profit before or earnings before interest and tax. Okay, this one concept, this comes in. Okay, how to calculate that? Right? You take your total income, you have taken your total income, what is that? 1030. Okay, you are subtracting cost of goods sold, you are subtracting HG expenses, you are subtracting miscellaneous expenses, you are subtracting dividend. Okay, but you are not subtracting interest expense. Please note that. So earnings before interest and tax. Okay, from the expenses, I am excluding interest and tax. Okay, but I am including depreciation. Please note that point. So this is called earnings before interest on tax. So EBIT 190. Okay. So what does that signify? What is the significance of EBIT? What does it actually reflect? Actually, somewhere I'm getting that answer. Operational? Okay. You exclude interest, you exclude tax. Okay. It is nothing but the ability of the company. Okay. It's a tool to gauge the operational efficiency of the company. In otherwise, the company is operating into some segment, which is nothing but your sale of textiles. Okay, it measures the profitability from that operational part alone. Okay, you are excluding interest, you are excluding tax. Okay, right? Interest illama, tax illama. What is the profit that the operations of the company generated, whatever it is. Okay, that is EBIT. EBIT. Correct? And from that EBIT, okay, when you include depreciation also into this, or when you move out depreciation, okay, C minus S minus M minus D, okay, and I remove that D. Okay, so that time I get earnings before interest and depreciation, which is popularly called as EBITDA. Okay, Normally you would have heard about that, right? Earnings before interest, depreciation, and appreciation. And amortization. It is called EBITDA. Okay. So here I measured the operating efficiency of the company indirectly. It's a tool to measure the operational outcome, okay? Whether it is able to generate profit or loss, that I measured. And here I also make it independent of depreciation. Okay, because it is a non-cash outflow. Understood? So there won't be any cash outgo, okay? Because you would have already incurred it long back, okay? You are only depreciating it now. There's no net outgo for this period because of depreciation. Okay? So, you will have that 40 rupees still in your hand as in form of cash. You would not have that, there would not have any cash outflow. Okay? So, for that purpose, okay, you come out with this metric, earnings before interest, depreciation and amortization. Okay, for the time being, you understand these three. Okay, PAT, EBIT and EBITDA. Okay, and then when Yogesh comes and takes cash flows, you will further elaborate it. Okay, if I elaborate it now, then our go to presentation so I'm not elaborating it. Right, so I'm just helping you understand profit after tax, the operational profit, and the operational profit sans depreciation. That's all. Okay, those three concepts, please understand. Okay, now I'll go to the next slide. Okay, which is very important from a P&L perspective. So what had happened? The company sold goods worth about 1,000 rupees. Okay. Next year, okay, the company sold goods about, it sold incremental goods, right? It was able to increase its sales by 20%. Okay, the sale was 1,000 rupees for the previous year. Okay, this year the company did well. Okay, and it was able to grow its sales by 20%. So I don't want to use the word it did well. I'm just saying it was able to increase the sales by 20% due to some reason. Okay. So cost of goods would have actually gone up. Understood? Okay. If you sold say 1,000 sarees last year, okay, you would have sold 20% more means. Okay, assume everything is volume growth. Okay, and I'm not going to the value terms. So the cost of goods sold would have also increased. So I am also inflating that cost of goods sold. Okay, cost of textiles sold also goes proportionately. It need not go proportionately, but for this case, I am assuming it. Okay, but the SD expenses of the company goes up only by 10%. Okay, miscellaneous expenses almost remains the same. Interest expenses, okay, since the company sold more, okay, the company's overdraft facility, it might have taken more amount of money as overdraft or a term loan. Okay, so his interest expense also goes up accordingly. Okay, the working capital needs goes up, right? Today, if I'm selling 1,000 sarees, if I think I'm going to sell 1,200 sarees next year, what would have happened is I would have actually small merchants. Okay, they would have actually taken more loans. Okay, they would have taken more overdraft facilities, and they would have actually increased. Okay, the interest cost also goes up. Okay, but remember, the shop remains the same. The shop remains the same shop. Okay, with the same fixtures. Okay, he is able to sell 20% more. Okay, which means he is better utilizing his capacity. His capacity utilization goes up. You all agree with me? The same shop, he sold goods worth 1,000 last year. This year he is selling goods worth 1,200. The same shop, the same proprietor, the same employee. That employee would have got only a 10% hike in salary, assuming, right? and he was able to grow his sale by 20%. His capacity utilization increases. Please understand that concept. You all agree, right? The same shop, the same man, the same employee, they are able to increase, sell more. Okay, so that's called your capacity utilization. What you call in all industries. Okay, when that happens, you see the impact on profit before tax. You see the impact on tax. You see the PAT, EBIT, and earnings before interest depreciation. Please note your sales went up by 20%. But here, your profit after tax went up by, your EBIT went up by how much? Your EBITDA went up by, this is called operating leverage. Okay? When you are, if you are able to cover all your fixed costs, okay, and if you are able to utilize your capacity better, if you are able to increase your utilization better, okay, what happens is your profit will increase disproportionately. It will increase more than your increase in sales. Right? This happens in real life in many companies. Okay? It happens in the economy also. Right? You would have heard about capex. Private capex not going up, government capex not going up. You can call it. In a way, you can call it. Okay? Okay? You would have heard about capex not going up, government capex not going up, private capex not going up, because the existing capacity utilized panla, and then why will people go for more capex? But whenever people, okay, the capacity utilization goes up in any industry, okay, please understand, there will be a disproportionate increase in your profitability. When that happens, the stock prices will go up significantly. As a fundamental analyst, if you are able to forecast this for a particular sector or for a particular company, you will make good amount of money. Okay? Very, 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 very important. Okay? So this concept is called operating leverage. Right? Higher capacity utilization, you are able to cover your fixed cost. Right? Okay, if your sales goes up by 20, your PAT goes up by 70, your EBITDA goes up by some say 39 odd percentage, and your EBIT increases by 47%. Right? So every company would actually strive to increase its capacity utilization better. How many of you are working in IT? Bench. அதான் அந்த கான்செப்ட் தான் சரியா பெஞ்சில் நிறைய பேர் இருந்தாங்கன்னா கம்பெனியோட லாபம் வந்து கம்மியா இருக்கும் பட் ஆஸ் அ பெஞ்ச் யூட்டிலைசேஷன் கோஸ் அப் as it crosses 1992 and whatever it is, okay, probably the profitability of the company might actually increase. எடுத்துக்கலாம். Okay, it need not be the maximum potential. Okay, that company can even, might be even 1,300 varaikkum kuda it can manage. I'm telling, okay, it depends, varies from company to company, okay. Till ideal value, lesser. See, normally what happens, when our capacity utilization crosses 85%, okay, in that case, the company starts adding newer capacity. Till then, they don't add newer capacity. Right? Usually, okay, that is the norm. Okay? Variable cost and fixed cost. So wait. We have just started the presentation. 1 more hour is there. We'll come there. Right? I'll come there. Okay. I have shown you the positives of operating leverage. There's also a negative to it. What if I flip it? There's a 20% reduction in sales. Okay. Oh. SDA expenses have increased by 10%, right? I have also increased the SDA expenses. Okay, you'll have to pay salary and all other things to your staff and other things. Power cost goes up 5% every year. So I factored in and I have increased the SDA. The depreciation motto I have not increased. Okay, because I have not added any capacity, I have not added any fixed asset more. Adinale, the same rack, the same computer, the same billing machine, I am able to generate 20% more business. Okay. If I expand my capacity, right, by adding more racks, then I would have definitely touched the depreciation aspect. Okay. Understood. I have not touched the depreciation aspect intentionally. I just want to keep it simple and help you understand the concept of operating leverage. ஒரு கம்பெனிக்கு capacity utilization increase ஆச்சுன்னா, okay, when the sales grows because of the growth in sales, right, the PAT and EBIT and EBITDA can actually go up higher than sales. Okay, higher than sales growth. I just want to convey that point, so don't complicate it further. Okay, so I've just kept it very simple. Ipo, there's also a very good chance the reverse will also happen. Business is cyclical, right? 20% down. Okay, up paranga. Operating leverage on the downside. 20% decrease in sales. Okay. Inge the cost of goods sold, I am not decreasing by 20%. Because normally what happens in such cases, right, if I have sold goods worth 1,000, okay, every businessman would be optimistic. Next year also, he will think he will sell for at least 1,000 and buy goods accordingly. Okay, so even by less goods, nobody anticipates a downturn, right? That's a problem, right? Everybody will, I mean, now obviously, right, every business done hoping to be optimistic, okay? Pessimists normally don't do business. That's a different story, right? So what he would have done is, he would have bought the same amount of goods, 400 rupees worth of goods, which he bought for 1,000. And this SD expenses will anyway go up. You will have to pay higher salary to your employees, the power cost will go up. Just because your business is going down, TNEB will not reduce your tariff, right? They'll keep on continuously increasing your tariff. Okay. Your SDA expenses goes up, miscellaneous expense remains the same, interest expense also remains the same, in tune with 400 rupees sales, okay, and the depreciation also remains the same. But look, profit before tax, ending up in loss, right? Loss nala tax right? Profit after tax, loss, right? EBIT loss. EBITDA alone, some saving rates is there in this particular example. That's all. But look at PAT. Just 20% decrease in sales. But how much the PAT has decreased? Okay. 67.5 rupees we made profit last year. This year we are making 140 rupees loss. Apply it goes down. So operating leverage cuts both ways. So in a P&L, when you analyze a company, okay, you need to analyze the long-term track record and understand, okay, how this operating leverage has behaved, how sensitive the company's PAT is to increase in or decrease in operating leverage. You will have to understand such concepts. If you understand that, right, you can actually play the cyclical team very well and make good amount of money in the market. Right? Please note that. Right? all cyclical companies, okay, companies which are cyclical in nature, whose business almost 95% of the companies, okay, are cyclical in nature only. They have some cycle. The cycle and the duration of the cycle differs. Every company will go through a boom phase. Every company will go through a bust phase. Every sector do that, right? So, any company, when you're analyzing, okay, just go back in time, okay, at least analyze the company for last 20 years. Last 20 years sort of financial, you will have to analyze deeply like this and try to understand this concept of operational leverage and how it has played out in the past. Okay, probably in social media would have come across a lot of posts. A country which forgets its history cannot create history. Similarly, if you don't learn the history of the company, right, you cannot create history by making money. That's all. That's as simple as that. So this operating leverage is very, very, very important. While analyzing a P&L, understand how that company's P&L has reacted to increase and decrease in operating leverage. Okay, there's one more leverage. I'm going there now. That's called financial leverage. Just like operating leverage, the financial leverage also plays a very, very, very big role. Okay, every companies borrow to expand their capacities, right? And when profits come, okay, what they do, they start repaying the loans. Accordingly, your interest expenses will go up and your interest expenses will come down. Okay, that will also have a very big impact on your, disproportionate impact on your PAT, EBIT and EBITDA. Okay, that's called financial leverage. Okay, so next time going there. Huh? அது பார்க்கலாம் அந்த கேசஸும் இருக்கு okay, right? வேற ஏதாவது cost would have actually gone up in that case. Sales would have gone up, okay, something else would have played spoil sport, okay, the cost would have gone up significantly. Okay, I'll show you, wait, there's one example I'll show you, okay, right? You'll get that example shortly in another 2-3 slides. So financial leverage, okay, the same company, the same textile company, okay, assume through some sources, okay, they repay the loan and their interest cost comes down. Earlier it was 100, 120, right, interest cost. Remember in the earlier 2 slides. Now, in the interest cost, okay, they repay some loan and it comes down to 60. Somehow they repay, okay, there are so many ways to repay the loan, I don't want to go into that, but somehow they repay the loan and then the interest cost comes down to 60. Okay, in that case, the sales goes up by 10% over the previous year, okay, but the interest cost comes down, right? But see the impact on PAT, EBIT and EBITDA. You need to understand this, the profit after tax that shows up beyond your sales. So the financial leverage comes into picture there, okay? It could actually work the other way also. Okay. In some companies, both operating and financial leverage comes into picture. Okay. In that case, those companies' earnings would be highly sensitive to capacity utilization. Okay. And their profitability would be highly sensitive to financial cost. Okay. In that case, those stocks of the companies would be extremely volatile. Right? If they fall, they'll continuously fall. If they rise, they'll continuously like crazy. Okay, if you're able to understand the cycle, right? You can actually, what you call, either sit on a multi-bagger or lose 90% of the money if you don't understand the cycle. That's very, 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 very important. So from P&L perspective, figure out the operating leverage aspect, figure out the financial leverage aspect, and how that has played out in the company over the last few years. Very, 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 very important. Yes. See, I think that and all will definitely show up. Such companies may not be favored by market significantly. Many companies do that. Next thing, they make use of some accounting provisions, and instead of expenses, they take it to capital. If they take it to capital, then slowly they will depreciate and amortize it. That expense will not happen on a lumpy fashion in 1 year. It will come under a depreciation part, some part of it. Okay. Once it is capitalized, in line with the depreciation policy, okay, it could actually come. Okay. I think this question, the next speaker, I think he should be in a better position to answer it. Okay, capitalization of expenses, how it happens, right? Yes, understanding financial and operating leverage. This is one company, this is a real-time example. This is not a buy or sell recommendation, just an illustrative example to demonstrate it. Okay. You see the last 3 years, 2020, 2021 and 2022. Okay. What do you observe? Huh? Okay. No, with respect to leverage. Okay. The revenue is going up. Okay, which indicates the capacity utilization might have also increased. Okay. Then what happens to interest expense? Coming down. Okay. Which means your financial leverage comes down. And what happened to your PAT, net profit? That also increases. Right? It also goes up. Just a classical example to explain both operating and financial leverage. Someone else asked, right? This need not go up proportionately. See the following year, following 2 years. See expenses. Okay, see expenses between 22 and 23. No, between 22 and 23. And also look how depreciation is behaving in 24. Okay. And 23 and 24, the interest cuts are going up again. Capex. So your depreciation expenses also goes up from 23, 24. Zoom it. It's not possible, right? No, anyway, I'll share with you the PPT, right? Right? This is one good case where operating and financial leverage would have played out, and due to increase in expenses, in some years it would not have also played out. So that's what you will have to understand, right? There's a huge decrease in expenses. I think most of you will have Google, right? Can you figure out the stock price movement from 2000 to 2022 or 23? When the company actually reduces debt significantly? 2.5 times. Or just even if you take pre-COVID level to post-COVID levels. Okay, I think it would have increased significantly. Right? Now, once again, the company is on a capex mode. Right? The interest rates have actually started going up again. If you look this 24, 25, just do that homework. Okay? Take 24 values and take 25 probable values. Just figure out the interest expenses. Just figure out the depreciation expenses. Okay, and also figure out your capacity utilization. Right? You will find the difference. Right? Now, last 2 years, the profitability could not have gone up significantly because the company is into capex mode. Okay, so please do that as an homework for this company, right? That will throw very valuable insights to you. The next 2 years I have deliberately I have left it. 24 is there, 25 you can figure out now, and then you see, right? I mean, what is causing a huge difference? So there are so many such examples. I just shared this example here. Exactly. Yes, to increase capacity, there are two ways. One is organic growth and another is inorganic growth. This company does both. They increase their own capacity in so many plants, and they also increase they also buy out. They have done a lot of buyouts over the last 2-3 years. Okay, they brought down the interest rates. So they brought down the interest cost significantly, and then once again they have started borrowing to buyouts. So even if you go back in time and see this 20 or 25-year track record of this company or companies in similar sectors, you will be able to appreciate both operating and financial leverage better. Yes, now this is another example. One of India's biggest FMCG players. This is the standalone statement of profit and loss for the year ended 31st March 2024. Okay, this I just snipped from the annual report, that's all. Okay, so please look into the various aspects. Income, the revenue from operations and other income, expenses, there are so many expenses. Okay, and then you have the profit before tax, you have the tax expenses, and finally you arrive at the profitability. When you look into an annual report of any company, you would actually see this. Right? The first thing that you should see in an annual report is this statement. But nowadays, first 100 pages, you will not find this. Okay. You will find only all those PR, marketing stuff, ESG, corporate governance stuff, and other things. More of gimmicks. Right? After 100, you will have to search for 100 pages, 120 pages to figure out. In that aspect, I appreciate the annual reports done by companies based out of Chennai. TVS Group, it'll be on a white book, that's all. No color, nothing. Straight you go, figure out everything, and finish it off. But other companies, obviously, they are into sales and marketing. This company is predominantly a marketing giant. So the first 100 pages, 120 pages in my annual report doesn't make any sense for a shareholder. Only after 120 pages you will find this. Right? Are you able to interpret anything by looking at these numbers? Huh? Okay. Okay. Right. Raw material cost? Come down, okay. Raw material cost has come down, which means they have bought less number of goods. Then how did their sales go up? Okay. Okay, like this you'll have to ask questions. Okay, raw material cost has come down. Okay. Then check inventory levels. Okay. Even if that has come down significantly, then ask when they have bought less goods for manufacturing. Okay, how did their sales go up? You'll have to ask those. Okay, which means this gate told that prices went up. Okay, which means the company did not have any volume growth. Might not have any volume growth. I don't want to go into it. I don't want to pass any comments, but I'm saying may not have had any significant volume growth. Okay, those are things you will have to ask. Okay, these are not just numbers. Okay, you will have to look deep into the numbers. How to look deep into the numbers? Huh? You need to go into each of those notes. That's what we are going to do now. Right. This is also another important aspect in P&L. Please know this: basic and diluted earning per share. Right. The simple profit and tax, they made it a little more complex because of all this types of expenses, right? And then finally, this earning per share. This matters to us a lot. Okay? Probably the one number which matters to us in the end would be this. Right? This earning per share. That has also seen a very marginal growth. Right? So this is how a summarized P&L will look. From the summarized P&L, you cannot make up too much. You cannot interpret it beyond a point. Right? So if you have to interpret it, even if you have to look deep into it, right? This is the earlier one, right? There's some miscellaneous expenses that are shot up, 500 crores. What other expenses have shot up according to you? Other expenses. Okay. What constitutes other expenses? Okay. No. We'll figure out. Wait. Don't come to any conclusion. Okay. Okay. What are other expenses? Don't come to any conclusion now. Wait. So that is the reason. Okay. By merely looking at this, you cannot make out beyond a point. You can make out something. Okay. I appreciate that. But if you have to look deep into it, right? You will have to interpret what exactly is the reason for this. Then you will have to go deep into